Right, hello. Today we're going to be talking about to what extent is a current account deficit a cause for concern. This is in your essay planning booklets, and we're talking about the balance of payments. We will also, at the end of today's video, talk about a current account surplus and try and reverse some of those arguments that we're talking about. First thing to do, can you try and look at this data, the current UK current account deficit, UK export performance, and our current levels of productivity in the UK, and can you look at those things and think about how you could apply this to this essay? How could you create 3 points based on economic growth, debt, and the exchange rate? So pause it now, give it a thought. Remember, it's that thought process that really aids your understanding. Come back and see how that's different or how that's the same as what I'm about to say. So we want to, first of all, talk about the first thing that you have to do is define accurately the current account deficit. This essay is about weak exports, so export revenue being weak, or import expenditure being strong, high. There are two possible reasons for your current account deficit. Net primary and secondary income also needs to come into the definition of the current account, and something to do with inflows and outflows, the outflows being larger than the inflows. Without that at the beginning, this essay does not make any sense and won't work. And please don't talk about a budget deficit. That's one surefire way to get zero in this essay. Or to talk about the current account surplus. Okay, our 3 points are going to be growth, debt, and the exchange rate. The two diagrams here, we're looking at an AD diagram and a exchange rate diagram. So economic growth. So we can first of all say, well, ultimately the reason or the outcome of whether we think that a current account deficit is a negative thing is based on, well, what is the cause? And our first cause is going to be high consumer confidence, easy access to credit, low interest rates. And that is really what was the case, right? We had easy access to credit, we've had low interest rates through the 2010s, and that has resulted in house prices rising, we've got wealth rising, and so consumer expenditure is also rising. And if consumer expenditure and incomes rise, not only does consumption rise, but imports rise. And if consumption and imports are rising, well, the imports rising, that's a leakage for your economy, that's an outflow from your current account. But if it is accompanied by high levels of consumption, then your AD is actually shifting to the right. Now that's somewhat complicated because you may say, well, hang on a minute, imports are outflows, leakages, so surely that's shifting AD to the left. Remember, consumption, 60% of AD, and therefore that's much bigger. And so if you're having consumption and imports rising at the same time, you're talking about booms, you're talking about going into lots of economic growth, demand pull inflation, those sorts of things, Y1 to YF. And therefore we're going to have some consumer-led growth. It's showing a good expanding economy. You may, if you are really feeling up to it, you can say, well, that results in the accelerator. Investment might increase as we see increased demand for local goods. And if you really went further, you could say that investment might result in future improvement in export competitiveness as well. So there are lots of things you could talk about there. But ultimately, a widening current account deficit is a symptom of a growing economy. And therefore, it is not a cause for concern. Go back to the question, it is not a cause for concern in this situation. However, evaluation, well, what happens if this is not an import issue? It's an export issue. Export revenue is low, not import expenditure is high. What happens if that's the case? Well, in the UK, we know that export performance isn't exactly great at the moment. The UK, as we can see going along around here, it is lagging behind in export performance. The real exports of goods and services are lagging behind. You could link that to Brexit, for example. You could link that to productivity. You could link that to what we have here. down here, we can see that UK GDP per hour worked as a percentage of the United States. We were almost at, say, 95% of the US at that point in 2000. We're almost as good as the US, and since then the US has grown at a relatively higher rate than the UK, meaning that US exports now are probably more competitive, and therefore we will sell fewer exports to the world. And that is a cause of real concern. And so therefore you could argue that, well, actually, this is really a cause for concern. Something that I have just forgotten, which you may also mention above, is that you may have been importing certain useful items such as capital. And if you were doing that, then that may well be a good, particularly if that's related to the investment that we saw there. Okay, point 2. Before I go to point 2, actually, you can reverse those points. If you had a current account surplus, you could say that the positive is that, well, I've got a productive economy because I've got lots of exports. You could say the negative, so switch the two around, and you could say that the negative could be that you have high levels of saving, low levels of consumer spending, which might in itself be an issue with your economy and show some sort of imbalance. You may well have lacking in certain areas, particularly consumer spending, and that, for example, is a symptom of, for example, a bad investment environment in China. For example, the lack of places that you could put your money in stock markets and the lack of faith in financial markets in that country. Okay, point 2. Point 2, increasing debt. So if we have a current account deficit, we must have a financial account surplus. And in this essay, you need to be able to then define a financial account and talk about what's in it. I want to see direct investment. I want to see portfolio investment. I want to see understanding of the financial account. Many of you, when you've written this essay before, haven't said that. And therefore, if you are going to have a current account deficit, you have to finance it. That has to come in through positive inflows of direct and portfolio investment, shares, bonds, savings, hot money, anything like that. And we talked in lesson about selling our football clubs, selling the Shard, all of those things. But the really important thing is to link, well, why is that a problem? And the problem is that we're going to have higher tax in the future to all those bonds that we sold. We need to pay them back. And therefore we're going to have to tax future generations at a higher rate, for example. Or we're going to have to forego the profits, forego the incomes that those assets that we've just sold to other countries would have given us. And those returns don't go to the future generations. Well, they do. They go to foreign future generations, not domestic future generations, which is an issue. And you really need to get into that idea of the future opportunity cost, the future higher tax, and that therefore meaning, go back to the question, that it is a concern, not necessarily for now, but it's a concern for the future generation. And there are opportunity costs arising as a result. Evaluation, well, it really does depend on the current account deficit as the percentage of GDP. And, well, how can I pay these things back? How can I have more tax revenue in the future? Well, if my economic growth rate is relatively high, then incomes in the future, profits in the future are going to be higher. And therefore, I'm going to have more tax. And I can use that tax to pay those debts back. I can probably set up more firms. I can probably have more investment. I can continue to sell those things in the future. And if we look at the UK current account deficit, well, it has bounced around a little bit. This is 0 going along there. You can see that, the purple line here, it has gone negative quite significantly there to around about negative 5% of GDP. That's a pretty big, pretty significant, but it's manageable. If it's that kind of level and you have a high growth economy, then that is a manageable thing to deal with. We can use our growth to offset the issues that we see in the financial account. We can go further with that and say, well, look, London is a international financial centre. It's able to pull in positive inflows into its financial account, and therefore it's possible that we can fund this, and therefore it's not a cause for concern. Finally, we could talk about currency depreciation in the sense that, well, import spending should increase outflows and increase the supply of the pound. Export revenues should decrease the demand for the pound and causing a depreciation and therefore import prices to rise. That could cause inflation in your economy, and we're seeing that now. We see that the UK has significant imported inflation, and that might be an issue. Give some application here. We've got 10.1% inflation, or whatever it is when you're watching this video. It's high, and therefore that's a cause for concern. But this may not be the case. We may not get a depreciation. Remember what we just said before, that London has a strong financial industry, and those inflows are actually causing the demand for the currency to rise. So when we said that demand for the currency fell because of poor export revenue, actually it might be rising because of, for example, portfolio investment. And that portfolio investment, or FDI, or whatever is coming into our current financial account, is pushing the demand for the pound to the right, pushing the currency back up again. Now, we've talked about Egypt and Sri Lanka in class, and if you don't have that, the experience of Sri Lanka and Egypt in currency crisis tells us that actually significant depreciations, or the alternative is to run out of foreign currency, can happen if you lose the confidence of speculators and foreign investors buying bonds or your currency. So you have to ensure that you're able to keep on selling those things to the rest of the world. If you don't, you're going to have a very, very big depreciation or devaluation in your currency, and that then causes big inflation and can set off a cycle of depreciations, current account deficits, financial account deficits, and then you get into a cycle of not being able to import anything at all, including fuel and food, and that is very, very dangerous. Okay, now, what happens? I've kind of neglected a little bit my current account surplus here. So the current account surplus for point 2, well, instead of increasing debt, you actually have increasing, you are actually buying debt from other countries, and you are having increasing flows back into net primary income in your current account. But you might consider, well, why is it necessary for this country to have to invest in foreign countries? Is there something wrong here in your domestic country whereby you're not able to invest in productive assets? Maybe you're not investing in infrastructure in your own country. So, for example, Saudi Arabia is investing in all sorts of things outside of the country, but it hasn't perhaps got investment projects within the country. Would it not be better to be, rather than buying football clubs in the UK, to be investing in their own education or their own cities or whatever they need to be doing, their own infrastructure? And so that might point to a problem within the domestic economy of lack of investment opportunities. It can well be destabilizing as well, but certainly a current account surplus is a much better thing to have, really, I think, and there are less issues. One issue you would have with a current account surplus, though, is you'd have a currency appreciation. And so you might say that the currency appreciation pushes export prices up and therefore might result in future issues with your competitiveness of your exports. And you're going to buy more imports as a result. So there is an interesting sort of automatic balancing mechanism that's happening there. Remember, that's not happening with China because it's buying lots of US government bonds out of its financial account, so that's then doing the opposite. Sorry if that was quite complicated. That was a lot there. In judgment then, well, it ultimately depends on your percentage GDP growth. I would say that this, yes, you can run a current account deficit. It can be persistent as well, as long as you are growing quickly and it's not a too big a percentage of your GDP. If you've got a big GDP, if you've got a big financial industry, then you are able to manage it. It also depends on the cause as well. If the cause is demand side growth, then that might show a very positive part of your economy. And it might also depend on whether you can then finance that through your financial accounts. Going back to the original question, is it a cause for concern? Well, a lot of this is actually a cause for concern because you are seeing that this is coming from the current account surpluses of imbalances in world trade. And therefore the world trade balances are, I think, a real cause for concern, and that is actually what's happening in real life. Right, we've got an awful lot there. Please do go back through it again. I realise I've said that quite quickly, but I hope that made sense.